Welcome to Wellness Wise Ways. We share practical wellness solutions for a balanced, sustainable life.
This is a summary of Financial Adulting, a book by Ashley Feinstein Gerstley. If managing your money feels overwhelming, it's probably because no one ever taught you how, says financial coach Ashley Feinstein Gerstley. She shows you how to handle the essential tasks of financial adulting, managing debt, saving for retirement, investing, and more, and guides you through building a financial plan that aligns with your values and will support the life you want. Whether you're just getting started or you want to level up, this book gives you tools to become a confident, empowered financial adult. Okay, let's hear takeaway 1. Don't leave your financial life to chance. Educate yourself, take control, and make your money work for you. Becoming a financial adult means taking control of your money in a thoughtful and informed way, understanding where it's going, planning for the future, and making values-based decisions. Contrary to what many people assume, financial adulthood doesn't automatically start when you get a job or move out of your parents' house. Some are forced into early financial adulthood due to poverty, inequity, or family circumstances. But for many, it takes a personal catalyst, a job change, a new relationship, or financial hardship to make them finally engage with their finances. Ironically, in a world full of information, most educational systems don't teach young people how to manage their finances. In addition, society makes it easy, even profitable, for some companies, such as debt collectors, to benefit from people's financial mistakes. For many individuals, emotional baggage, the confusing jargon of finance, and a lack of trust in financial professionals only add to the challenge. Systemic barriers, wage gaps, racial injustice, financial discrimination, and more also make it difficult for many people to take advantage of their financial lives. Yet despite the odds, anyone can start becoming financially literate by taking small, consistent steps. Financial adulthood isn't about being perfect. It's about becoming aware, taking action, and aligning your financial choices with what matters most to you. Here's the second takeaway. To keep yourself motivated, set goals for your financial future. Instead of simply reacting to financial stress, set goals that allow you to be proactive and intentional. These objectives can be practical, like building an emergency fund or saving for retirement, or they can be personal, such as budgeting for a monthly treat or planning a big trip. When your financial decisions are tied to goals, you are more likely to stay motivated and on track. Organize and prioritize your goals in the following 5 steps. First, start with your dreams. Set a 10-minute timer and let yourself list everything you want to do, have, or experience with money, both practical and fun. Examples might be saving $5,000 for an emergency fund, going to Italy next year, or raising $20,000 to start a side business. Second, don't forget the essentials. Add important goals like accumulating retirement savings and making debt payments. Be specific. Pay off $3,000 in credit card debt. Third, prioritize your goals in terms of importance and urgency. Think about what matters most right now and what will have the biggest financial impact. For instance, your top 3 goals might be, in order, building a crisis fund, starting a retirement account, and paying off 20% of your credit card debt. Fourth, state each goal in SMART format. Make your goals specific, measurable, attainable, relevant, and time-bound. The 5 elements of SMART goals. For example, save $3,000 for my emergency fund by putting away $250 each month for 12 months. The 5th step is select a few goals as your immediate focus. Pick a manageable number so you don't spread your efforts too thin. For instance, you might work on building your emergency fund, contributing to your retirement account, and saving for a vacation. Time for the next takeaway. Create a financial plan by mapping out your yearly income and expenses. Create an accurate estimate of your income for the next year by first determining exactly how much money hits your bank account with each paycheck. your net income. Also, note your pay frequency, monthly, biweekly, or weekly. Multiply accordingly to find your total yearly income, and divide the result by 12 to estimate your average monthly income. If your pay fluctuates, base your pay on a conservative monthly average. If you're self-employed or running a side business, remember to set aside a percentage, typically around 30%, for taxes. Next, focus your monthly expenses for the year by listing everything you currently spend money on, including both regular and occasional purchases. List your fixed expenses like rent or loan payments, flexible spending like groceries and transportation, and variable costs such as holiday gifts or subscriptions. Don't guess. Look back at your past 12 months of bank and credit card statements to get a realistic sense of what you actually spend, including smaller purchases you might overlook. Then add in any new or upgraded lifestyle expenses you expect for this year, such as a gym membership or an extra trip. For each item on your list of expenses, estimate the monthly or annual cost. For example, if you pay $100 per week for groceries, plan for around $433 a month, accounting for 4.33 weeks per month, not just 4. Some large or occasional costs won't fit easily into a regular monthly budget. Prepare for these by creating a sinking fund for each, a separate savings stash for specific future expenses. For example, if you expect to spend $1,200 on holiday gifts, set aside $100 per month in a dedicated savings account. Start with 1 or 2 sinking funds, automate your transfers, and store the money in a high-yield savings account. Let's listen to Takeaway 4. Spend your money ethically and with intention in alignment with your values. Where you spend your money matters, and aligning your spending with your values, intentionally supporting certain businesses, products, and services, can contribute to building the kind of world you want to see. This could look like shopping at women or BIPOC-owned businesses, buying from companies with ethical labor practices, or choosing eco-conscious brands. To guide your decisions, develop a personal set of criteria by reflecting on what matters most to you, such as environmental sustainability, fair wages, or local economic impact, and ranking these concerns in order of importance. For example, you might prioritize pays living wages, uses recycled materials, and BIPOC-owned. Once your criteria are set, conduct a spending audit by reviewing your recent expenses and rating each one based on how well it aligns with your values, either on a 1 to 5 scale or just by a simple yes or no. For instance, if you purchase groceries at a major chain, but supporting local stores is a priority for you, that expense will score low. After your audit, identify the expenses you'd like to shift. Then create a consumer activism plan by choosing one recurring expenditure to switch each month. Update your spending plan to reflect these changes. Remember, even gradual adjustments can lead to meaningful impacts when they're done consistently and intentionally. All right, here's the 5th takeaway. To make the most of your savings, build your retirement portfolio early and manage it often. Understanding your retirement account options starts with knowing what kind of plan your employer makes available to you. If you're employed full-time by a company in the United States, you likely have access to a 401k, which allows you to contribute a percentage of your paycheck before taxes and potentially receiving a matching amount from your employer, essentially free money toward your future. If your company doesn't offer a 401k, or if you're self-employed or working part-time, you can open an individual retirement account, IRA, on your own. Once you know your account type, run a few retirement calculators based on your current age, your predicted retirement age, your current savings, and the amount of money you'd like to be able to live on when you retire. For example, if you want to have $60,000 available annually during your retirement, and you expect to need 25 years' worth of retirement funds, multiplying $60,000 by 25 will give you a rough savings goal of $1.5 million. The calculators will show you how much you should be contributing each year to reach your goal by the time you retire. Next, decide how to invest the money you save. Choose an asset allocation, your ideal mix of stocks, bonds, and cash, based on your age and comfort with risk. One simple rule of thumb: 120 minus your age equals the percentage that should be in stocks. The rest goes into bonds. From there, research the available investment funds in your plan. If you're in a 401k, your options may be limited, but look for low-fee stock and bond index funds or a target date fund based on your expected retirement year. You can also set your investments to be automatic, meaning you contribute a percentage of each paycheck according to your chosen investment allocation. Over time, rebalance your portfolio periodically to maintain the ideal mix. Here's another takeaway. Invest your money so it will grow as you work. Beyond your 401k, investing in the stock market is a great way to increase your money, and you can start at any time. First, decide how hands-on you'd like to be. If you like full control and want to take advantage of lower costs, you can invest on your own by opening a brokerage account. If you want to take a set-it-and-forget-it approach, a robo-advisor can automatically manage your investments for a small fee. Consider obtaining personalized advice as a fee-only fiduciary financial advisor or certified financial planner, CFP, might be worth the cost, especially if you have significant assets or complex goals. For example, people saving for both retirement and their children's college costs might benefit from talking with a planner who can map out how to fit those pieces together. When you open either a brokerage or robo-advisor account, look for one with no account minimums, zero trading fees, low or no maintenance fees, and solid customer reviews. Then it's time to choose specific investment vehicles. Most experts recommend passively managed index funds or exchange-traded funds, which are diversified broadly and charge lower fees than actively managed funds. To align your investments with your values, look into ESG funds, which screen companies based on environmental, social, and governance criteria. When possible, automate your contributions to build wealth consistently and avoid emotional decision-making. If you have existing investments scattered in old accounts, such as 401ks from past jobs, consider rolling them into your current 401k or an IRA to simplify management and reduce fees. Now for the seventh takeaway. Start preparing for tax time a year in advance. Taxes can be tricky, confusing, and stressful, so make sure filing them goes as smoothly as possible. Start by updating your W-4 with your employer anytime your life circumstances change, such as if you get married, have a child, or pick up a side job. This form helps your employer know how much tax to withhold from your paycheck. To determine this amount yourself, you can use an online calculator that the Internal Revenue Service provides. When it comes time to file, gather your W-2 form for salaried income, 1099 forms for freelance or other types of income, and any tax-related documents you've received from banks or investment accounts, such as records of student loan interest or IRA contributions. Having this information in one place, either physically or in a digital folder, will make the process faster and easier. Look into whether you qualify for common tax credits, which directly reduce how much you owe, or deductions which reduce your taxable income. For example, contributing to a traditional IRA or health savings account, HSA, might reduce your tax bill, and items such as student loan interest and childcare expenses may qualify for credits. To make next year's tax season less stressful, set up a system now. Keep a checklist of all the documents you needed this year and use it as a guide to preparing for next year. If you had to dig around to find receipts or donation records, create a monthly reminder to save those going forward. If possible, automate your contributions to tax-advantaged accounts like your IRA or 401k and track your deductible expenses, such as home office costs or charitable gifts, throughout the year. If you didn't get to take advantage of a deduction this year, make a plan that will enable you to use it next year, such as by increasing your retirement contributions. Decide how you will file your taxes, on your own, free if your income qualifies, using tax prep software, or by hiring a professional. And make a note of what worked well this year so you'll be better prepared next time. We've reached the 8th and final takeaway. If you get into debt, know your options and make a plan to pay it down. Debt comes in many forms. It typically starts with credit cards, which are essentially revolving loans that allow you to borrow money up to a set limit. Each month, the credit card company requires you to make at least a minimum payment, often just 1% to 3% of the outstanding balance. If you don't pay your full balance, the company will charge you interest on the remaining amount. And that interest can add up fast, especially with average interest rates topping 20%. To make credit cards work for you and not against you, it's smart to pay your balance weekly, so your bank account will reflect what you've actually spent. Consider using a separate card for work travel, and look for cards that offer perks that align with your lifestyle, such as travel points or cash back on groceries. Just make sure those perks outweigh any annual fees. If you've fallen behind on payments or find yourself carrying a balance, don't panic. You can use practical strategies to regain control. First, call your card issuers and ask for a reduction in your interest rate, especially if you've been a reliable customer. You can also ask the companies to waive any late fees you've incurred. To create a payoff plan, take inventory of all your debts. List each credit card or loan and its balance, interest rate, payment due date, and minimum payment. Once you lay everything out, choose a payoff strategy. In the snowball method, you prioritize paying the card that has the smallest balance. The avalanche strategy targets paying down the debt that has the highest interest rate. And with the emotional method, you attack the debt that bugs you the most. Aim to stop adding to your debt while consistently paying more than the minimum on your top priority account. With a clear plan and tools like a cash tracker to manage your spending, you can start reducing what you owe and the stress that comes with it. You were listening to a summary of Financial Adulting, a book by Ashley Feinstein Gerstley. Finally, let's listen to the 8 takeaways one more time. Takeaway 1. Don't leave your financial life to chance. Educate yourself, take control, and make your money work for you. Takeaway 2. To keep yourself motivated, set goals for your financial future. Takeaway 3. Create a financial plan by mapping out your yearly income and expenses. Takeaway number 4. Spend your money ethically and with intention, in alignment with your values. Takeaway 5. To make the most of your savings, build your retirement portfolio early and manage it often. Takeaway 6. Invest your money so it will grow as you work. Takeaway 7. Start preparing for tax time a year in advance. And the final takeaway, if you get into debt, know your options and make a plan to pay it down.
You've been listening to Wellness Wise Ways. Follow us for more inspiring reads and a balanced, mindful life.